Hey there, YouTube family. Stocks with Josh here. There's a lot going on in the markets today, and there was a lot going on in the world. Russia, for instance, has stepped up its war campaign against the Ukraine with indiscriminate bombing across the country. And in France, there is no gas. There are mile-long lines at the pump. People just lined up trying to get a tank of gas so they can get on with their lives. Over in Europe, there was protesting all across the European countries of the high cost of living. People basically, they're not trying to overthrow governments. They're not trying to be rioters. They just simply can't afford to pay their bills, and they're hitting the streets to say to their politicians, what's going on? We trusted you guys, and now things have gotten out of control. This isn't fair. Over in Germany and Italy, people have begun to get some of those electric bills have been coming in. They're realizing what's ahead of them. They can't afford to pay them now. They can't afford to heat their homes right now. And they're looking over there in Russia, bombing the Ukraine, which is where a lot of the oil and gas comes from. And so they're seeing the writing on the wall that things are going to get worse. And they're out hitting the streets saying, what are we going to do? Over in China, there is actually a movement right now to flat out stop paying their mortgages. It was spreading all over social media. People were actually getting to the streets, and they were taking their mortgage bills and throwing them into a dumpster fire. And this got squashed by the government. They shut down those social media lines of communication. They're trying to keep things from spinning out of control. So it is pretty crazy what's going on in the world right now. And one point I want you guys to take away from all of that is, do you guys think that chaos has been priced into this market right now? We're 20% down, and I'm going to tell you that I don't believe that it's been priced in just yet. In truth, it could be argued that markets are actually doing better than they should right now, but we're beginning to see some of the early signals. We saw that UBS came out and downgraded companies like Procter & Gamble and Bristol Myers. Those are normally solid investments. Those are the more stable blue chip companies that often you're told you should be buying rather than AMC or SHIB, but they're getting downgraded. And so what does that tell us about what to expect moving forward? I'm going to tell you guys, this week we have a lot going on. 3 state feds will be talking. 2 of them talked today and 1 will be talking tomorrow, and their message is going to be hawkish. I told you guys when I gave you the analogy of the train ride that the Fed that's in charge of slowing the train down and pulling the brakes, they're going to communicate to the back of the train and get the word out that everybody needs to be taking a seat because it's going to be getting hawkish. There will be no dovish speak coming from the Fed right now. This is too critical of a moment where he is trying to reach a very specific interest rate hike, which I told you guys before is that 4.4 or higher. He needs to get there so that that interest rate hike can possibly begin to give us the difference that we need to slow the train down. On Wednesday, we're going to get the latest Fed meeting notes. And I think that after we get those notes, we're going to see a big spike in the expectation of a 100 basis rate hike. I think the notes are going to be designed to be hawkish, and myself expecting a 75 basis point hike. But I believe that when we get them on Wednesday, a lot of people are going to be saying, hey, this should be a 100 basis rate hike. These guys are super hawkish. But it's all going to come down to the CPI data report that's coming out Thursday, and which measures inflation. And that's really where the Fed is going to be looking and taking his cues from. The CPI report stands for Consumer Price Index, and what that's going to tell us is what's going on with inflation. And we are hoping that it would be a huge surprise that inflation will have decreased. But at this point in time, as we saw the other day with the jobs data report, things have not slowed down. And these things are all leading into the earnings that we're going to begin to see. We know that we have the big 5 tech company earnings ahead of us. And I can tell you right now that in this current environment and all the bearish things that I mentioned, if any of these big tech companies miss their earnings, they're going to be slaughtered. There are no sweetheart companies in the market right now. Even Apple is beginning to have to pay for performance. People need to see you can't be coming up with a meet. You have to show up with a beat expectations, blow it out of the water type of performance, or the stock is absolutely going to be crumbled. I will be looking at put calls for some of the big tech companies if I believe that they're not going to hit their targets. I think there's far more of a chance of that going into these earnings than anything else, because the expectation of the market is just going to be so much higher. What it took to get a pass or what it took to rally in the past isn't in place right now. So companies are going to have to come out and they're going to have to exceed revenue, exceed earnings. It's going to have to be an upset to the upside. In addition to the FOMC meeting notes Wednesday, we actually have the PPI, which is the Producer Price Index. That is the cost of goods for manufacturers. That's also going to be something that can move the markets. Friday, we have the October Consumer Sentiment Report, and I believe that's going to be a big one as well, because that measures consumers' attitude towards their money and their finances. And as I just told you guys, that sentiment in Europe has got to be at a low because people are just not slowing down their spending. They've taken the time to go buy some paper and a stick, write a protest message, and hit the streets. And so I am not imagining that the consumer's attitude here in the US is going to be very high. I am imagining it's going to be low, and that will also move the markets. This moves the markets because it kind of tells the analysts what to expect in this holiday season. Are people slowing down their spending? And if so, what are the companies that's going to affect? That's where we're going to begin to see the lowered earnings that are potentially going to come out, which actually would be bad news. And it's funny because we're having a situation where strength is affecting the markets negatively, but bad news and the slowing economy actually could affect the markets positively. I'm going to touch on that a little bit at the end. Hey, hit that like for me. Join the conversation on this page by hitting the subscribe and the notification bell. You guys know that we're not afraid of these markets. There's a lot of bearish stuff going on, but if you know what you're doing and you're connected and you have an eye for the charts, you can make money 365 days a year, whether the market is going up or down. So we're not scared. We are getting prepared. So I'm going to jump into a chart of the SPX for you guys and give you a little bit of an idea of what I'm looking at for the rest of this week. But before we do, this video is sponsored by MooMoo. There is a link in the description of the video. You can get 15 free stocks for opening up and funding an account. It's a great offer from them right now. We use them because they have their 16 trading hours as well as their 8 different order types. But if you put in just $100 right now, you'll guaranteed 6 stock and 6 chances at $2,000 each. That's a pretty good offer. If you've already got it or you can't get it, I appreciate your patience when I share it. Okay, we're looking at the daily chart of the SPX, which measures the S&P 500. I want to point out some very simple things here. One, we've pretty much had a double bottom right here. You can see that the stock prices have come down, they've gone up, and we've come back down to that same area. Now I want to point out the RSI, Relative Strength Index, and you see that even though the prices are relatively flat on the SPX, we see that over here there is bullish divergence because this measures momentum of selling. Right now, when it's beneath the 50% mark, it means that the bears are in charge. We know that the bears are in charge right now. We know that when we get these breaks above the 50% mark, that's when the bulls are in charge. We saw that when it broke here. It tested that range 3 times before on the 3rd time it broke through, and we got that beautiful move to the upside. In addition to that, we talked about the thrust signal that we got last week, and the last time we got it was right here. And after we received it, we had 3 days down that were then followed by a number of days up before we got into this area of consolidation. So we got the thrust signal here, right here on this day, and we have had these 3 days down. And so we are wondering or anticipating, are we going to get a move back up? And could we test this line of resistance that the market has come up against twice? Could we test this one more time, bringing us back to the 3,800 range before getting rejected and possibly moving lower? So right now, I have been looking at and talking to you guys about some of my trades, and the range of that trading window is really going to be this week, ideally. I don't know exactly where we'll get this pop, but I am anticipating a potential pop up to test this line. Of course, we know that the markets could be unpredictable. All of the data could come out really bad, and we could just see this extend and continue to the downside. It doesn't have to come back up here and test it. However, we did see that happen here in the past. We had more than one test to this downward line before ultimately moving up. And so I think that we're looking for a similar area of consolidation right here, but we're looking for it right here. That's generally what I've got in mind with the SPX. All right, in conclusion, as I mentioned Sunday night, from now on, good news is bad news and bad news is good news in these markets. There is certain news that's going to hit the markets differently. I'm going to just say CPI, PPI, and consumer. Those are the types of bad news that actually will cause the market to go down. But bad earnings reports, chaos in the world, Russia attacking the Ukraine, these types of things actually could have a bullish effect if they cause the economy to slow down and begin to send the message to the Fed that the economy is slowing on its own and he doesn't need to pull a hard brake on it. He could ease up or pivot away from out hawking the hawks, and he could go slightly dovish. Right now, that's not the case. Right now, we're still being heavily data driven. That's why I'm focusing on it so much with you guys and trying to bring what these reports mean and how they're being interpreted right now, because we are totally data driven. Whether this market goes and has its next leg down, which I think is very, very possible, is going to come because of a CPI report or a PPI report or the jobs report. And in the case of good news, like earnings being beat, that's just going to tell the Fed that the market is still strong and the companies are just barreling forward, making record profits. And that actually, even though it's good news, is going to be bad news. Some bad news is going to be good and some good news is going to be bad. But we'll go through it together. I appreciate you guys being part of this family. You know I love you guys. Peace and blessings until tomorrow.